All right, let's get into it. Today, we're cracking open a really complex, data-driven playbook. And this thing is designed for one single purpose: to navigate a seriously treacherous market. We're going to break this whole high-level strategy down piece by piece.
And it all kicks off with a directive that, well, looks like this. I mean, it is just packed with jargon, right? You've got defensive convexity, anchor fragility, amplifiers, tripwires. It honestly looks like code, and, in a way, it kind of is.
So the first question on everyone's mind has to be, what on earth does any of that mean? Well, that's exactly what we're going to do today. We are going to translate this entire strategy into plain, simple English.
Okay, so first things first, we need to understand the problem that actually triggered this playbook in the first place. The system has officially confirmed what it calls a fragility breach, and you should really think of this as a code red alert for the entire market stability.
So here it is. This is basically the Situation Room dashboard, and you can see two critical safety levels already breached. That's for the SPY, which, tracks the S&P 500, and for Bitcoin. Meanwhile, TSLA is just teetering on a cliff, and the VIX, what a lot of people call the market's fear index, it is flashing a serious warning. The takeaway here is crystal clear. The market is officially in defensive mode.
So, a code red has been confirmed. What's the plan? Well, in a situation like this, you don't improvise. You turn to a pre-designed strategy. It's time to open up the defensive playbook.
The core of the strategy is something called the defensive convexity stack. Yeah, I know, that's a mouthful, but the concept behind it is actually pretty simple. It's basically a way to use options, specifically puts, which are just bets that an asset's price will fall to protect your capital and maybe even profit from a downturn. The number one goal here isn't getting rich quick. It's all about survival. And this chart, this really reveals the discipline that's right at the heart of the playbook. I mean, look at this. Even with all those alarms flashing, a maximum of just 15% of the portfolio is actually at risk. A massive 87% is held safely in reserve, on the sidelines. This whole strategy is built from the ground up on making calculated, limited-risk bets.
All right, so let's get to the players on the field and see how this whole thing is built. The playbook doesn't just pick random assets. No way. Each one has a very specific role to play in this defensive formation. You've got your anchor, your amplifier, and your hedge.
Okay, so the anchor, that's SPY. This is your main bet that the entire market is weak. It's the foundational play. Then you have the amplifier, which is TSLA. Now this is a much more aggressive conditional bet. It only gets activated if that SPY breakdown is confirmed, and its whole job is to capitalize on what could be a much faster, more dramatic drop.
And then, of course, you've got your insurance policies. The BTC puts are a hedge against Bitcoin, which is often seen as a leading indicator for weakness in the market. And the UVXY calls, those are bets that volatility is about to spike. Well, that's the ultimate fear gauge hedge. But this position is special. It only gets activated if the VIX crosses its tripwire, which is a signal that real panic might be starting to set in.
I mean, this all sounds incredibly specific, doesn't it? So how on earth does the system decide to make these bets with so much conviction? Well, the answer lies in the secret intel that's being fed to it by two really powerful analytical engines.
Let me introduce you to CUPA and ESPRE. The easiest way to think of them is like this. CUPA is your meteorologist. It crunches all the data and asks one simple question. Where's the market most likely to go? It generates a probability forecast just like a weather report. Then ESPRE steps in. It's the value hunter. It looks at CUPA's forecast and asks, okay, so if that's what's likely to happen, are the options, the actual bets we need to make to play that forecast, a good deal right now?
And here's where it gets really interesting. This is how Keepa's forecast provides that rock-solid conviction. This isn't just a gut feeling. Keepa has actually calculated a 55% probability that the SPY is going to continue to fall. Compare that to only a 20% chance of a real recovery. The data is clearly pointing down.
And then, here's the clincher. ESPRE comes in and confirms the entire logic. It has scanned the market and found that puts, remember, those are the insurance policies against a drop, are basically on sale right now. They are undervalued, especially when you compare them to the high probability of a fall that CUPA just identified. It's an incredibly powerful 1-2 punch of analysis.
But look, a great plan and all the best intel in the world are completely useless without discipline. And that's why this playbook has strict, non-negotiable rules of engagement. And they're all designed to do one thing: protect capital at all costs.
Rule number one is the big one, the most important. a hard cap. Absolutely no more than 15% of total capital can be exposed to risk, period. And under these fragile conditions, that rule gets even tighter, down to 12%. See, survival is always the top priority.
And what about a true emergency? For that, there's the kill switch protocol. The best way to think about this is like the eject button in a fighter jet. If the market goes from a controlled fall into an absolute nosedive, which is defined here as SPY dropping below 640 and the VIX spiking above 18, the system's command is simple and immediate: flatten all risk. It just gets out completely to protect whatever capital is left.
Okay, so with all this talk about defense, you're probably wondering, what would it actually take for the system to finally turn bullish and start buying again? Well, that is governed by the final part of this playbook, the flip-long protocol.
Now, this is not about guesswork. It's not about trying to catch a falling knife, as they say. The flip-long protocol is an incredibly strict, data-driven checklist, and it was designed for one very specific reason: to prevent the system from getting fooled by a temporary bounce, a dead cat bounce, that has no real strength behind it.
And here it is, the all-clear checklist. There are 4 non-negotiable conditions, and the most important word here is and. Not 1, not 2, but all 4 of these gates have to be unlocked at the same time. SPY, Bitcoin, and TSLA all have to prove their strength by reclaiming key levels, and fear has to visibly exit the market with the VIX falling. Only then, and I mean only then, is it time to even think about turning bullish.
Which, of course, leads us with a final, pretty important question to chew on. In an era that feels like it's defined by market chaos, is this kind of extreme, unemotional, data-driven discipline the future of how we navigate it all? It's definitely something to think about.